Welcome everyone to the 2024 NOAA Fisheries EBFM seminar series. And we've continued this series since 2017, and our aim has been to increase awareness with our colleagues as well as with the public regarding ecosystem-based management and highlight the progress that not only NOAA has taken, but our partners are making it to enhance and implement EBM strategies. As you can see, the NOAA Library continues to be a valuable co-host for the series since its inception, and we hold these seminars on the second Wednesday of each month from 3 to 4. And as Cassandra pointed out, you can access these presentations after the fact on their YouTube channel, and we encourage you to share that with your colleagues who probably couldn't join us today. Today we are so lucky to have Dr. Howard Townsend joining us. He's an ecologist within NOAA Fisheries in the Office of Science and Technology. And he's been serving as our ecosystem modeling coordinator. And he's really making inroads with his colleagues in terms of looking at evaluating U.S. fisheries in a portfolio analysis and trying to compare levels of risk. So I welcome Howard again this year. He joined us early in the year with an earlier presentation, and he's back to join us again this month. So again, thank you so much, Howard, for all your effort and your team as well.
All right. Okay, so thank you to Peg and Cassandra and all the library staff for organizing this seminar series. Also want to thank all the co-authors listed here. This has been, we're developing a body of work here. We're working with NOAA Fisheries and with some colleagues from SMAS, this, School of Marine Science and Technology at UMass Dartmouth. So appreciate all the efforts that they have put into this as well. And also thank you everyone for tuning into this presentation. I have intentionally made this a shorter presentation because I really would like to generate some discussion and maybe have some time for questions and comments following the presentation. So please come with a participatory mindset. Thank you. All right, so we're going to talk about investment portfolios a little bit first. I think most everyone online here is probably familiar with investment portfolio. It's just a collection of assets like stocks, bonds, mutual funds, exchange traded funds, real estate, cash equivalents, all kinds of that you might have, to keep your wealth in that you're trying to accumulate. Many of us have retirement accounts or other accounts, similar investments. So we have some intuitive understanding about the risk return trade-offs with these types of investments. We often, when we're looking at retirement funds or that sort of thing, we have options for mutual funds or retirement plans where we can select a portfolio based on our risk tolerance. Maybe we're younger and we're ready for a high risk but high return, or maybe as we get a little older, we want a lower risk, low return. So there's this sort of portfolio mindset that I think we can also apply to thinking about how we manage fisheries in a given region, given ecosystem. So just to touch on the ecosystem part a little bit, ecosystem-based fisheries management is one of the major drivers in NOAA Fisheries, one of our major missions. Often fisheries managers are tasked with looking at the biological aspects of a fishery stock, maybe setting harvest rates and biomass targets, and look at the spatial distribution. But this also requires a system level thinking, not just about the single species, but also the species interactions and some of the socioeconomics, especially in EBFM. And we have all the legal mandates we need for managing fisheries in this ecosystem way. So it's advisable, and I'm going to move forward with this idea that thinking of regional fisheries ecosystems as a portfolio of harvested species is in line with system-level EBFM approaches. It enables us to consider things like species interactions, whether it's ecological interactions or technical gear interactions, and socioeconomic considerations, all of multiple species, multiple fisheries, in a way that I think we have some intuitive level of understanding. Um, so on sort of the first level of thinking about it, it's just you know, if you look at them, you look at a time series of an investment portfolio. You have various stocks or bonds or things that you might look at and might consider investing in, and a time series of what their value is, as it changes over time. Similarly, we can look at uh, landings. I mean, easily accessible. We have information on annual landings for fishery and look at it by each species. So already we have sort of a similar data structure to work with. Um, so treating fisheries in a region, we can sort of think of it like an investment portfolio to come up with some useful insights. So that's what I want to walk through with you today is to how to evaluate these regional fisheries portfolios like an investment portfolio to understand how to optimize fisheries at a regional level, how to be efficient. Um, Now there are a few drawbacks, or not drawbacks, caveats, I should say. Stocks we can readily get daily information on the value. Uh, we can get some finer scale time time information, but usually it's the most readily available information is on an annual time step, and so there's other sort of exogenous factors that will influence how these how these stocks might be interrelated and connected. So that's one thing we have to take into account in this analysis. Uh, and the other thing is that with stocks and bonds, you have a virtually unlimited supply of the stock. You can buy as much as you want to try to optimize your returns and minimize your risk. Whereas fisheries, we have some ecological and regulatory constraints, but we'll walk through those. But the general idea is there that you can think of these in a very similar way. So what I'm going to be drawing on is sort of modern portfolio theory that has its roots from starting back in 1952 with Markowitz and others. Assuming a lot of rational people, as economists like to do, um, that if you offer uh, the same expected return to someone who is purchasing a portfolio, they would tend to prefer the less risky one, right? So that's sort of the whole idea here is that been used widely in managing financial investment accounts, retirement accounts, those sorts of things. Um, in modern portfolio theory, assets like bonds and stocks are in an investment portfolio are selected jointly to minimize the overall risk associated with a specific target for the return on the investment. So that's general idea. Now I'm going to go through this a little bit. This is thick, and this is economists and financial analysts developed this. I'm an ecologist that sorted this out a bit and worked with others. But I should also mention that earlier papers, Jen et al., Sankarikyo et al., Edwards et al., um, have explored this a bit. And so what I'm doing different here is not focusing on one region, but trying to look at multiple regions. But just to kind of walk through this, I know it's a big hairy equation, and I'll come back and explain things a bit more a bit later. But the idea is that we want to minimize this covariance, or minimize the variance. I'm sorry, looking at the covariance and the weights we have on each of our assets, whether it's a asset in the stock sense or asset in the fishery sense, so that we achieve a target level of return given certain constraints, right? So um, just to say that again a little more slowly, we're minimizing the variance, the risk for a target level of return, uh, given constraints that we might have on how much stock you can buy or how many fish you can fish. And the other thing I've done here is traditionally this covariance term takes into account the variance within a single species, but also the covariance between different species, different stocks over time. And so I think of that as sort of an EBFM approach, so where we would make decisions thinking about the whole portfolio at one time. That I've taken that covariance matrix and just looked at the diagonal, so it's just the variance. So we're not thinking about how species are. There's correlations in their landings values. So that's why we have these two different portfolio or these efficient frontiers for your portfolio. So all we've done here is, with a given portfolio, look at the correlations and say, how would you adjust these weights? How would you change the level of revenue to achieve a theoretical optimal, where you've minimized the risk for a given level? The other useful bit here is that we can also then look at this theoretical efficient frontier compared to an actual point B, the actual realized mean and variance of a portfolio, to say there's a difference here between what was theoretically achievable and what we achieved, so that we could come up with this idea of a risk gap. This basically, how much more variance risk did you take on for the return that was achieved for a given portfolio? And I changed risk to standard, instead of variance, standard deviation, because these are in terms of dollars. Variance would be squared dollars, and dollars are rectangular, so I wanted to make it an easier number to use there. Okay, so the risk gap. All right. So just to say this all again in a little simpler, and these slides, I can make them available if you want to chew on them a little bit more. So we have a portfolio, a combination of assets, efficient frontier, sort of the theoretical minimized variance given a level for a given level of return. Targets, so all we do is use a quadratic optimization algorithm, set a target, and have the optimization algorithm tell me what's, calculate those W's, those weights on each of the species, to say what to help create this efficient frontier for each of these dots. The risk, I have to be clear that I say this is not talking about biological risk, this is financial risk, variance or standard deviation in the revenue. Then there's the realized revenue risk, or mean and variance in a given portfolio, versus the theoretical efficient frontier. And then the risk gap is just the difference between what was realized and the theoretical optimal level. And of course, all this is dependent on the covariance matrix. So, I didn't mean to put inverse relationship. It's just the relationship between portfolio species landings. The negative covariance is, of course, the inverse relationship, but there's also positive relationships, positive covariance. So just to take, the root of all this is something like this. We look at the different species, and I should say this is a covariance matrix from a different paper from a co-author, Lauren Brewster, but it was a good illustration. Look at the different species and their landings over a given time period to see whether they're strongly positively, medium positively, strongly negatively, or somewhat negatively correlated. Use that to adjust the weights for an efficient, but then use the actual implicit weights from the realized mean variance to come up with the actual level, and to come up with a risk gap. Now to dive into the methods a little bit, I was grateful to have readily available some landings and fisheries values data from the Fisheries One-Stop Shop. And I intended to look at each region in the U.S., or roughly Management Council and regions and Fisheries One-Stop Shop are correlated or associated. So tended to look at those. I looked at, for each region, the top 25 landed species by revenue value for all that fisheries in a region for each of the regions in the U.S. And I looked, considered my portfolio to be from 1990 to 2020. That was the intention. We found that we didn't have adequate data for Western Pacific, Hawaii, and the Caribbean, so those are excluded from this. And there's also a few caveats on some of the other regions that I'll go into it for a bit, but very convenient to have readily available data from the Office of Science Technology that compiled this. So one of the things you want to do when you start to do this is let's just look at what the landings were like for your portfolio and how they might have changed over the years. So you don't want to get into the details here. I have a link to the paper at the end of this if you want to read more detail about this, but just to look at general patterns and trends and the landings in the different regions and the species composition of those landings. Yeah, because those will become important for establishing the regulatory constraints and ecological constraints. Again, I'm just creating portfolios based on the top 25 landed species by values. You might create a portfolio based on the actual species managed by a council or by a group of species that are in a similar fisheries management plan. There's lots of ways to do this, and even you could do it in different time resolutions using different data sets, such as logbooks or that sort of thing. So this is really demonstration of how this approach can be used. And looking at the landings helps us to understand some constraints. One of the constraints I had was that in developing the optimal portfolio, I had the constraint that we can never catch more than 80% of the highest landed biomass of a given species. So that puts some limits on it. And so of course, you could add a lot more constraints to it. It's a pretty flexible approach. Then also, ultimately, we're looking at correlations in covariance in the revenue. So, good idea to look at how the revenue might have changed over time for your portfolio. Look at patterns and trends, and come back to this after you've done your analysis to help explain the results you got. So some just quick results. There's kind of two ways of doing these portfolios and comparing them to the optimal value. So for these dots, these are the past 10 years, so from 2020 back to 2010, where the realized portfolio revenue and risk was compared to the optimal portfolio or the efficient frontier. And you can see pretty straightforward that the reddish orange line is always higher. The EBFM line is always higher than the single species blue line, and that's because you're helping to minimize variance by taking into account the covariance between species. But the other big pattern we see here is that there's no regions that are dead on the reddish orange line. A few that are kind of somewhere in between the single species and ecosystem-based fisheries management efficiency frontier. South Atlantic is pretty close, but this is where one of the caveats comes in. Is South Atlantic is this is commercial landings that I got from Fisheries One-Stop Shop. There's a lot of recreational landings that you probably would want to consider as well when doing this sort of approach, because there will be interplay between commercial and recreational fisheries as well as across species. So that's one approach. The other approach that's more correct but a lot harder to follow, but I just feel like I have to show it, is that you generate the efficient frontier for every end year of of your portfolio from starting from 1990 to 2020. And I should also mention these are 2020 adjusted. I think I had that in the previous slide. These are adjusted to 2020 dollars, so it's inflation adjusted. But again, same pattern still shows up here, that there's no region that's hitting the red line real hard for any given year. There's some that are in between, and many of them that are closer to the blue line. So, and sort of this demonstration approach, it shows, yeah, all of these regions are taking on more financial risk for the level of revenue gained in the portfolio than is theoretically necessary. The next step is to look at the risk gap. I think this could be a very useful indicator. There's sort of two ways to look at it. There's sort of the risk gap per dollar in the gray here. So that's going to range from 0 to 1. And I've got this dotted line that says it's 0.05. So that's, think of this as anything at this line is taking on 5 cents more risk per dollar than you theoretically would need to do. And then the red line puts this in actual dollar terms in over the time period. So what does this mean in the sort of big picture sense? If we look at the actual dollar value in that risk gap, 5-year mean is around 90 million for Alaska and down to 5 million for South Atlantic. Again, this scales with the revenue. So Alaska has a higher revenue overall. So if you look back here, the risk per dollar is pretty comparable looking at the two figures. But so broad first cut look, U.S. fisheries appear to be taking on more risk than necessary for, the theoretically necessary for revenue levels achieved in a regional portfolio. And I feel like this portfolio analysis and this risk gap would be really good, useful system level indicators, because it's capturing the technical interactions, the species interactions, and the some socioeconomic factors that go into landings to help us keep track of how efficient, how closely are we moving towards an efficient EBFM sort of frontier. So some recommendations and next steps. I think, again, this portfolio analysis approach is a method for generating ecosystem level indicators and approaches for implementing EBFM. It's a good approach. It's fairly intuitive because most of us have some intuitive level understanding of our investment portfolios from the financial world. And so I think it translates well, and it speaks to efficiency, in a broad sense of our fisheries. I would suggest, again, this is my broad brush demonstration approach, that this can be done fairly readily. And we have R code. If anybody's interested in trying this out for themselves, I can share the GitHub with you. Where you can grab the R code and apply it to a different portfolio if you'd like. But I think I wouldn't go forward and make recommendations based off of this. You want to be more careful in how you think about the portfolio. Again, I just used the top 25 landed species by value for each region. Maybe there's some species in there that a region has no management control over, or that sort of thing. So you would want to just carefully consider that. Also carefully consider the constraints on the harvest levels. I kept it fairly simple, just saying for developing the efficient frontiers, I allowed the algorithm to let the catch levels go up to 80% of the highest historical level of landings. and biomass and landings. I think it'd be really useful to integrate this with a multi-species or ecosystem model to sort of do some simulation testing to explore potential ecological control rules or ecological economic control, harvest control rules based on that risk gap and changing the weights on how landings are done for each species. We also would want to do a more thorough treatment of the uncertainty in the data, the analytical methods, consider, incorporate environmental climate variability and uncertainty in the constraints. I think it's all pretty achievable. I mentioned earlier that I was part of a larger group that's been working on this. This is sort of the first paper out the door, looking at all the regions. The next papers are more focused on New England and South Atlantic, where they've more thoroughly selected the species, thought about species based on the management council purview, and we've worked closely with the the Northeast and or New England and South Atlantic Management Council to start getting their feedback on this as part of a LINFEST funded project with our colleagues in SMAST. So I think there's a lot of potential here. There's going to be additional papers with that more focused work in the New England and South Atlantic councils, as well as a grad student working on coupling this approach with some multi-species ecosystem models to more thoroughly evaluate this. Other ideas that I forgot to write here was I think it's quite feasible to incorporate recreational fisheries. We just need that same sort of time series, and it wasn't readily available for this analysis, but with a little additional work, you could probably generate time series for the recreational fisheries, and even incorporate a broader range of species and ideas here. So with that, we're at about half past the hour, so I'll just say thank you for your attention. There's a NOAA Fisheries news story about this, as well as the AFS Fisheries Journal article about it. I encourage you to take a look at it, and I'll hopefully have provided enough information to get some useful comments and have some discussions and questions here. So with that, I will stop sharing my slides and let folks take over for leading the question and answer.
All right, for our first question, who can minimize the risk in a region? Is it a council issue or individual fisherman decision?
Very good question. And it depends on how you apply this. You could see, for example, an industry group or even a given, company could apply this approach for the species they catch and use this to help them make decisions how to be most efficient with their decisions. You could apply this at a council level and use it for the species managed by the council to help them make decisions on or on how to adjust regulations if they find there's, not the level of efficiency they would like. At least to start exploring that. Again, I should say, do this risk gap, then go back and look at your landings and revenue and correlation matrix and see what makes sense. I'm not saying that this is just an automated thing, but it's certainly, you could, if you have, like a fishing industry would have access to daily data, so you could look at your results over a month or from year to year, and use this to help sort of think about the efficiency of your system.
Our next question is, so it sounds like you are using in covariances between species to ID the best mix of species. You said you constrain by top 80% of catch over the past 30 years. Do you also limit by current estimates of sustainable F?
Yeah. So I should say I didn't use the covariance to come up with the best mix of species. I just said took the data, said, in this region, one of the top 25 species by landings value, and so didn't do any of that covariance analysis before that. But you could also look at the covariance matrix. There's no, that requires a prior thought. What do you want to do? What species you want to look at, that sort of thing. The constraint, I did include, just looked at 80% of historical catch, whatever the maximum catch is, and use that as a constraint. You could also set an F target, other constraints in there. That would take a little more work to go back through all those years to figure out what those limits were, or to have some other model associated with what those should be. But you certainly could use that as your constraints. There's lots of ways to think about the constraints. I was doing this analysis to keep things quick and simple. I thought the 80% of maximum catch would be a reasonably conservative constraint, but you could certainly, there's any number of ways you could configure the constraints for the optimization.
Our next question, thank you for this presentation. The weights are the proportion of each species, or the absolute number of each species. And policymakers would then set limits based on the optimal weights?
Yeah, that's certainly an approach you could take to this. If a policymaker were to decide, yeah, we want to start managing this way, those weights are in the covariance matrix. They're just, when you take that covariance matrix and multiply it times the weights, that's how you calculate the variance. And so, yeah, that's not an absolute number. It's a relative number. So you would say, and we have this in the next paper that's coming out, where we look at a more thorough analysis of the weights, the theoretical weights to get the optimum efficient frontier, and the actual realized weights. So you could compare those weights and say, for a given species, the optimal weight is higher or lower than the realized weight, so we should adjust that realized weight. It's a little tricky because it's weight on landings revenue, so you'd have to translate between landings revenue and an actual catch. But yeah, that's sort of the idea, and that would take a bit more analysis and looking into.
Can this modeling approach be used for ESA species risk analysis instead of commercial fisheries?
I think so, and I think you could use it in the mix. So with these commercially landed species, you could also have, if you had some measure of value for your ESA species, that you could translate to dollars, or if there's some way to translate these dollars to, some common currency. As long as you have a common currency, you can use this optimization approach in a time series. And so it would be interesting to do that. You don't want to make sure you have the scaling fairly reasonable on this. I'm not an economist. I don't know exactly how to do it, but just the idea of mechanically putting in a time series with values is a fairly straightforward thing to do. How you actually value those ESA species, that's therein lies the rub, as they say, and that's outside of my expertise. But if somebody's interested in that, I'd love to talk with you more about it.
How can we take the data and persuade those who provide funding that we need to move into ecosystem-based fishery management, rather than just looking at MSY models?
That's a good question, and I think I'm not trying to supplant current methods. I'm suggesting this is an additional method to use and to think about, because I think it's, would take some time, right? You have to sort of, as we've been doing with the New England and South Atlantic councils, start to expose them to the ideas, let them ask questions. I think we also need to do some simulation testing with an ecosystem model to test this method out. But I think this is a method that essentially, gives us a good EBFM indicator that could potentially augment what we do with MSY models. If you had a set of species and stock assessments that you'd run, and you came up with one set of advice based on that, then use this approach to come up with another set of advice and just start to compare those and evaluate that. But I think it would take some time, a few go rounds with management councils or commissions or whoever's working on it. But I think this does speak. I think this is strong in that it does sort of summarize a lot of EBFM information in one thing. It's species and technical interactions and some economics, and it's a single indicator, and it's there's an intuitive level of understanding. I know that the math and stuff was maybe not intuitive, but there's an intuitive level of understanding. People think about their investment portfolios. They can, that curve makes some relative sense, and trying to move towards efficiency in the curve makes sense. But it would take a lot of passes to. But I think it's good. Get started. Presenting this in addition to the current information we provide.
Are there any ways that you could perform this assessment in data poor fisheries in any other ways without collecting more data? The example given for the U.S. Caribbean.
Yeah, there's certainly, again, it's, this was nice because we had a lot of commercial landed value. If there's other ways of getting those dollar values of those fish, literature review, interviews, but we need some history. You could even look at, number of fishermen. Again, I'm not a social scientist, so I don't know all the different approaches, but I feel like there's ways that you could, generate that time series of value, essentially. If there's reasonable ways that people can agree on, I think that this could be a data poor method. I mean, this is, in one sense, this is data poor in that it's not a lot of biological information in here. It's just looking at correlations, in fisheries. So it's fairly straightforward in that sense.
Was the processing capacity of the fishery taken into account? And do you know if there are good indicators for measuring that?
That's a really good question. So this is just using fisheries one-stop shop, and my understanding that's just X vessel price. Somebody from that group could correct me if I'm wrong if they're on the line. Fisheries, the processing capacity. One approach I've been learning about recently and have tinkered around with a bit is EcoPath with EcoSim. An ecosystem model has a value chain module on it where you can add different levels of the value chain of the fishery, the X vessel value, processing value, employment associated with processing value, distribution, employment, value, employment and value, up to restaurant. As much as you can get data for, you could add those things on and develop a broader understanding of the full value chain of a fishery. Again, I'm not an economist. I've seen papers done this, and it was applied in Peru several years ago, and it seemed to be useful for the Peruvian Ministry of Fisheries back when it was used.
Thank you for your presentation. Has anyone looked into the reasons why our fisheries operate at high levels of financial risk, and how much of it is a management issue versus other socioeconomic and behavioral factors?
All right, it's tough when you get social scientists and economists asking ecologists questions like this, but I haven't looked at it, and I'm hesitant to say it's high levels of risk. It's just theoretically higher levels than, or levels higher than what's theoretically achievable. And so part of that is we do have sort of a single species approach. We make decisions in most cases, of course, there are uh, aggregated fisheries management plans, but in most cases, a single species. And so just looking at the blue versus the orange lines, when you don't take into account those those correlations between species, you're not accounting for some of that risk and managing that. And so I think that's part of the reason. There's probably an economist who could go much more in depth, but just from this analysis, that's what I'd say. It's like we're more towards that single species, my single species way of looking at where it's just looking at the risk within a species instead of across species.
One problem with the efficient frontier in finance is how sensitive it is to relatively small changes in data timeframe. How stable are the fisheries data over time?
That's a really good question, and that's why I suggested in a lot more sort of uncertainty analysis and some simulation testing. Use an ecosystem or multi-species model to generate these portfolios and evaluate that. I don't have a good sense of the sensitivity. There's also something I haven't explored yet, but in the whole financial literature, there's sensitivity analysis you can do that haven't explored that yet. But we got a team of folks who are working on this and will probably continue to work on this. So those are good questions to be thinking about.
Good afternoon. Do you have data from the U.S. Virgin Islands?
That's a good question, and it's been a while since I've gotten back into the data. As I said early in the presentation, that I excluded Caribbean and Pacific Islands because for what I was attempting to do, looking at 30 years of data in the top 25 landed species, there wasn't adequate data. All the data I got was from Fisheries One-Stop Shop. You'd have to look into that a bit for the commercial for the commercial landings data. And again, that was the quick and easy access data. I can just download that from the web. There's certainly data collected from logbooks, and I'm not familiar with how that's done in the Virgin Islands, but in theory it would exist. I don't know in practice how things work there.
How can method be adapted to account for spatiotemporal heterogeneity of the stocks and fleet segments? Is this handled by a sensitivity analysis or variance score for the geographic or temporal area studied?
That's a really, really good question. I hope we're capturing these questions for me to think about later on this. So one simple way to do, the approach I've taken looking over 10 years or 30 years, certainly there's going to be some heterogeneity that's influencing these results. You could certainly look at finer timescale data in smaller regions and vary the size of the regions to help explore that. I would certainly think a sensitivity analysis where you would adjust, what your geographic region is, what your time period is, because the efficient frontier does change, and certainly there's some of that, that's in the analysis that I've done that you want to really kick the tires on that before you try to move forward with this approach for actual decision making.
How could you see this implemented as part of a participatory modeling approach?
That's a really good question, and I think participatory modeling is going to be very important for EBFM. So I think that's one of the reasons I like this method is if you had a group of stakeholders and policymakers that were in this approach with you, and you talk through this approach with them, I think it makes, again, I was saying, some level of intuition about it, because we all think about financial markets and that sort of stuff and think about this optimization, but maybe haven't thought about fisheries being used in this way. So just to present this to them, and then imagine several years later where you're starting to move towards trying to use this to help guide fishing, you could show um, changes that would be necessary to move towards more efficient fishing, efficient fishing. That's fun to say. But what that means is for a given stock, you'd have less risk or for your overall portfolio, and it would depend on sort of the risk aversion level of the participants. What they would want to do, what they would be willing to do um, uh, to to take on less risk and be more efficient. So that's a partial answer, and I'm glad to talk with you about it more. But again, you get into questions that are we got to bring more social scientists in on this as well. I think to think about how people would feel about this sort of approach, and uh, but I think the idea that it incorporates the economics is helpful.
Okay, well, thank you, Howard, for this Q&A. It has been really great, and thank you, audience, for all the questions that you have submitted to us. If you think of any questions later on after the seminar, Howard's email is in the chat, and you can follow up with him if you would like. And then, Peg, do you have any last comments?
I just wanted to thank Howard again, and to you, Cassandra, for all your efforts putting this together. We're lining up some great talks for the next year, so I always like hearing recommendations from the audience. So if folks have any other recommendations for next year, please let me know. It's just peg.brady@noaa.gov. And as I said, we have some great speakers coming in the first part of the year. And again, it's the second Wednesday of each month at 3 p.m. And these are obviously all recorded and left on the YouTube channel that NOAA Library maintains. So please share it with your colleagues for folks who couldn't join us today and listen to Howard's presentation. So thanks, Cassandra, and thank you again, Howard. Great job.
Thank you.
Yes, thanks to you both, and thank you, audience, for joining us today. We hope to see you at our seminars in the future.